Good morning, and thank you for everybody who's joining us today. I am Joanne Hamburg with the Real Estate Exchange, and I'm excited to be with Mike. He is with Evolve Mortgage, and we're going to talk about alternative financing options. And Mike, could you tell us a little bit about yourself and your company?
Yeah, thanks so much for having me, Joanne. I've been doing mortgages now for about 8 years. I've been involved for the last about 4.5 years, so it's pretty much most of my career has been spent here. Absolutely love it. I also do real estate investing as well, so I'm very focused on this non-traditional financing options because sometimes it's a great way, especially with conventional financing options. They limit you to 10 mortgages with Fannie and Freddie, so these loans are something that I use a lot for my investor clients, and I'm really excited to start teaching people ways to create financial freedom through non-conventional financing and real estate investing.
You mean people want more than 10 mortgages?
Yeah, there's a lot of investors out there. I do have a couple of clients that hit the 10 mark in the last couple months, so they've been getting into these non-QM non-traditional financing options more and more so to keep their portfolio growing.
And it's difficult. Once, you would think it would get easier, but it's more difficult when you own more properties. I mean, I know just from my own experience that there aren't a lot of lenders that I don't want to put anyone down, but they have a hard time with evaluating all the different entities, because even though we may have multiple mortgages, sometimes they're under multiple entities.
Exactly. And that's
Yes.
one of the issues, and that's why I love this non-traditional financing, because when you're looking at a conventional financing option on an investment property, now we're analyzing every property you own, your profit and loss statements on all of those. We're analyzing reserves for each one of those properties you own as well too. So as you get more properties, you need to have a larger reserve account, and that kind of goes away with some of these options that we're going to talk about today.
Yeah. So you mentioned QM loans. What does QM stand for?
So QM is a qualified mortgage, which is your conventional loans, your Fannie, Freddie, FHA loans. Those are what's called qualified mortgages. When you look at non-traditional financing, they call it a non-qualified mortgage. It's a way to get some of the federal regulations to differentiate. Because on these, we might not be validating income the same way. We might not be, looking at income even the same way as well too. Case in point, some of these loans we're going to talk about, bank statement loans, DSCR loans, they have very unique ways to look at your income to help you qualify.
It's very interesting. I know, like I said, just from what I've experienced over the years, it can be very interesting. And finding a lender that's willing to work with you, like, what are the typical lenders that offer these type of untraditional financing?
So they're mostly broker options. You could do some small banks that'll have portfolio lending, and they'll hold it in-house, using their bank deposits to lend the money out. A lot of private hedges will be doing it as well too, and then they offer it to a lot of mortgage companies or banks that might not have an appetite for it, or maybe even the bandwidth on their portfolio to have it, and they can broker it out to them because we're out there originating. They're just the people with the money, and they don't want to be out there originating loans.
Yeah. So there's a bunch of different types of non-traditional loans. What about bank statement loans? How does that work, and what kind of documentation is required to qualify for one of these?
Yeah, so bank statement loans are actually one of the most popular ones to go about this option, because it's not just to buy investment properties. You could also use this to buy primary residences. The nice thing about these is, especially self-employed, we know everyone is trying to limit their tax liability. And when they're doing that, when you look at conventional loans, you look at the normal routes that people would go for a 30-year mortgage, there's very strict income calculations that we have to use. Using a bank statement loan, we can take either 12 or 24 months of either your personal or your business bank accounts. And then there's a whole formula that we look at what's going in, what's going out, to determine the eligibility of what we're going to be using for income. And then that way we can figure out what you could quote unquote qualify for using those. So it's a real simple process. I mean, it's the same thing as getting a mortgage. You still got to get your bank statements. It's a lot more bank statements. And depending on the program, like I said, it's either 12 or 24 months. The more popular option is the 12-month. And then your typical, you need a photo ID, things like that to prove who you are.
That'd be helpful, huh?
Yeah.
Not using someone else's information. What about interest rates on a bank statement loan? Do they find that they're traditionally higher?
Yes, definitely traditionally higher. And sometimes they will come with a point or so that you are going to be charged, and a point is just 1% of your loan amount. So example, you have a $500,000 loan amount, they're going to charge you 1 point, they're going to charge you $5,000 for that. They are larger because what you got to think about is they are taking a larger risk by the way they're calculating your income. And there's a smaller pool of investors as well too that are willing to do these loans. So, it's the old rule, he who has the gold makes the rules.
Yeah.
So I always tell people prepared, it's not going to be like what you see on the news in the low sevens or high sixes, depending on the week that you're looking at right now. You're probably looking at maybe high sevens, low to mid eights, depending on the scenario. And probably if it's a primary residence in Massachusetts, you're not going to have a prepayment penalty, but you will have probably a prepayment penalty of 1, 2, or 3 years. And if you choose not to have one, that's where they're going to charge you more points up front as well too, if you're doing this for like an investment property.
Yeah. We have a note, and I'm not sure what your abbreviation stands for, DSCR loan.
Yes, so that's a debt service coverage ratio loan. So
Okay.
these are awesome loans for investors. I use these. I probably close at least 1 or 2 of these a month right now. So what it is a really cool option to take the proposed rents of the property. We do a formula, and as long as that covers the debt of that property, we can move forward closing that loan. On top, one of the cool things about those loans is, let's say you own, in my examples earlier, we were talking about how people own 10, 15, 20 properties, whatever it might be. When they own that many properties, you might have to do a reserve account, which could be 3 or 6 months, depending on the scenario. With the debt service coverage ratio loan, DSCR, you only need to have reserves for that property, not all 10, 15, 20 properties that you might have. So it's really, really helpful. And this is one that you are going to see, the rates are going to be higher, depending on how the yield works with the yield spread inversions in the bond market. I actually was seeing last fall and this winter where rates were going up. We were starting to see a lot better rates in the debt service coverage ratio loans. This is because they have these appetites for it, and it's not as impacted by the bond market from what we saw this winter. So it was only a little bit higher than what Fannie or Freddie was charging for investment properties.
So that's not bad. What kind of credit rating are they going to be looking for? A lot of times folks end up going like FHA, or, they're always looking for a program because, some of us have a lot of mortgages and a lot of
Yep.
debts, and sometimes your credit score can go up and down. But like, what kind of credit score do they normally look for? Is it different on these two type of loans?
Yeah, so the debts, the DSCR loans, they are normally looking for a higher credit score. I have some investors that'll go down 680. They'll change it for the loan to value as well too. They might consider something lower, and making an exception to their rules. That's something cool about these loans is if you're working with I have a couple different investors for these options, and you might be able to get an exception because, oh hey, listen, my score was 679 and I needed to do a 75 LTV cash out refinance. They might give you that exception because it was only 1 point, whereas a conventional loan, cutoffs to cutoffs, that's how it is. So they do want better credit scores, and they do want better loan to values. So most of these loans, you're putting at least 25% down for the DSCR investors, depending on what type of property it is.
What about on the statement loan,
Bank statement loans, you're looking probably about 20% down. There's some investors that might go 10% down for the right scenario. But it's the other thing too is it can be a little bit difficult to find a PMI company as well too. So that's why normally you're looking at about 20% down for those bank statement loans as well too.
One thing you just mentioned is that it sounds like you could use either one of these loans to refinance a property and do 75%.
Yep. So you could also use these loans to refinance. So if let's say you have an investment property you bought a couple years ago, you've done some work to it, it's gone up in value, and now you want to take your investment out of it, we can use one of these DSCR loans to do a cash out refinance, pull your initial investment out or more if you want, so that way you can go buy another property. And you could sit there and have 75% loan to value on there and then pull out whatever the 25 difference is. So we do see that very frequently. And the nice thing about these DSCR loans is you can close in an LLC to help, mitigate any liability and risk that you're looking to help mitigate.
Yeah, most conventional loans, they don't want you to close in an LLC.
No, you have to close as a natural
Afterwards.
person. Yeah, and it gets tricky too, because technically any change to the title is supposed to go back to the investor and things like that. So, you see all these, I call them Facebook and YouTube gurus out there saying, oh, just go out there, buy a property for this and then move it into an LLC. Well, Fannie and Freddie are going to start catching on to those things. So you have to be very, very careful because they'll call those notes due. Because there was a title change. So always be cautious and make sure you're trying to, understand what's going on your mortgage so you don't get stuck losing one of the nice rates. I've had some clients that, have 3, 4s, and 5% on some of their investment properties. And they're like, oh, I want to move into an LLC. I was like, don't, let's go talk to your attorney and figure out a different way to mitigate this to help you out.
Yeah, just to make sure you protect yourself,
Exactly.
The closing process, is it about the same timeline as a regular loan, or do you find that it takes a little longer, or is it quicker?
So it all depends on the investor, honestly. I've had some that we've closed in 17 days before. I have another one that, because of how many moving parts are going on with the loan, we're almost at day 50. So it depends on the investor and how complicated your scenario is. So we can see these typically about 30 hours, but it can change a little bit based off, are you moving LLCs? Or are you selling it from one LLC and going to another LLC, but you technically are on both? There's a lot more that goes into these loans and a lot more details that can be overlooked, even simply sending an operating agreement on LLC and not realizing that that operating agreement was the original one. And now there's been a revision and you're 52% owner, 60% owner, and the other partner's 40. We don't have that. That can change things if it doesn't match things that we can find online and everything like that.
Interesting. So here's a good one. How about hard money lenders?
Hard
Our
money.
old loan sharks,
Yes.
but tell us, do you have an outlet for that? I mean, we've done a couple here on properties. Just recently, we had a property that needed a lot of rehab, and we were not able to obtain financing because of the condition of the property and the extent of the rehab that it needed. So we opted to go with a hard money lender, short term, to get the property in a condition that, would be financeable. And then we're gonna, not me particularly, then my client is gonna refinance and get out of the hard money lender. I mean, loan option. How has that worked for you in the past, and how are you guys handling those?
So yeah, we do have an outlet. Great guy, and he helps me shop around between different, almost like investment firms. I really want to call it, because that's what it comes with hard money. It's these people that have private money and they just want to invest. They want a certain return on their money and they know they're going to get it. So normally you're getting charged a couple points easy right off the bat. Normally it's going to be exactly, this is a short-term option. You are not in these loans for a long time because the rates can be very high. I mean, I just saw one, we were doing a DSCR refinance. We got the payoff and I saw that he was paying almost 16% interest on the loan. And then he also had paid 2 points up, 2.5 points up front
Gonna
for
say,
the loan. So they are very expensive. You got to make sure that you do your numbers and know your numbers. That's the most important thing when it comes to real estate investing anyways. But you really have to make sure you understand your numbers, how long you're going to be carrying this loan, what the timeline is going to be, and build in cushions. Because I mean, if anything, like COVID taught us, you never know when you're going to get a delay on cabinets. You never know when you're going to get any of these delays that happen. And that can start really adding up with these loans. So we do see much higher rates on these. It's whatever they say goes, whatever they want goes. They make the rules. It's like I said, it's the golden rule. He who has the gold makes the rules in these
yeah,
scenarios. So they're a great option, especially for some people where if they take a look at the value, you might not have to put some money down because the renovation cost, they'll be able to finance the renovation costs and the acquisition. On some of the hard money lenders out there, because they're going to say, okay, well, you have experience, this and that, and they look at all those attributes to make sure that they're putting their money in something sound. They don't want something risky. Yeah, they're going to charge you a lot for it, but they want to make sure that their money is going to be safe too.
well, at the end of the day, they can foreclose on the property, so they want to make sure that, there's a lot of cost involved with the foreclosure.
Exactly.
And nobody wants to get into that point. Do you find that they're normally will amortize and they'll set up similar terms on a hard money lender? Like, will it be a short term with a balloon? Or would it be amortized over 30 years? What kind of terms have you seen for these type of loans?
So what I've seen on these is it all depends on what you're doing. Are you buying a property because it's cash only, it needs like a septic system or something like that? Yeah, they might give you a little bit of a break. Are you doing it as a renovation, fix and flip, they call them? It all depends on how they're set up. I've seen some where it's like, hey, listen, we'll lend you the money for 5 years. There's a balloon. Here's our ridiculous interest rate. You can refinance, whenever. I've seen a lot of the fix and flips ones where they're like, okay, well, here it is. You have 12 months to refinance. In 12 months, we want this note's being called due. Otherwise, here's the expenses of fees that you're going to incur by not paying this off in 12 months. So it all depends on what you're looking to do, but they have very different amortization schedules and terms to, work up with different scenarios that make sense. Because if you're buying a property, with a hard money lender that's for a fix and flip, it's not necessarily going to be something that's going to make sense for a long-term hold where it might be, 10 plus, 20 plus units or something like that.
Yeah, and really you have to kind of have a good idea of your numbers and make sure that you can cover it for that period of time. I know one of the things we talked about, like the risk associated, the biggest thing is not making your payments and having the property foreclosed on and then losing.
Exactly.
And if you're not making the payments like you're supposed to, it'll affect your credit. So then it kind of limits you on being able to apply for conventional or, another type of loan. Um, any suggestions for like investors with preparing financially to be an attractive candidate for this type of loan? Like what kind of things should an investor start like thinking about if they know that they're not going to be going with regular financing because the property's a total tear down or it's, you we get them, you're
Yep.
laughing, but some of these houses we've gotten, I mean, some of the ones I've bought were borderline bring over the excavator and call it a day. So yeah, it really depends how far you want to take it. So like septic systems, I don't want to say that's easy, but that's a pretty much a no-brainer today. There's so many people that can do the septics and stuff. But when you have a house that needs roof, windows, siding, water, sewer, total rent, total once over, what kind of things should an investor be thinking about?
So first, you want to figure out your exit strategy. That's the best advice I can give people. You need to figure out your exit strategy before you get into anything. So if it's going to be a fix and flip, you need to know when that's going to happen, what your numbers are going to be, what your timeline is going to be. Build in those little bit of cushions as well to know it. Even on a long-term hold, you want to know what the end game is. Is this end game to hold it for 30 years, 40 years, whatever it might be? Are you going to hold this for 10 years and do a 1031 exchange and maybe, this is a 4 or 5 unit property? And now you know that you want to use this to leverage later on and do a 1031 exchange and do a 10 or 20 unit property. These are all things that you need to consider before you even look at things. Financially, the best thing I could ask is don't move money around. It's very hard for people to do that. It's so hard. I'm guilty of it myself. But moving money around kind of creates a little bit of chaos in the bank statement. So a couple ways that I've seen a lot of investors do it is they use one credit card to buy everything, all their materials, everything like that, or maybe two credit cards, whatever it might be. So their bank statement is, hey, just money going in, and then they're only paying off one credit card. It's when you start using that debit card to, okay, well, I just bought coffee for $2.99. I just bought supplies for $1,500. Like, it makes a bank statement messy and kind of can throw things off. So go ahead, use your credit card. As long as it's paid off in full by the payment date, you're not going to pay any interest on it. You probably get some points too, which is always a good thing.
Points are nice.
Exactly. So always clean up your
But
finances, make it as simple as possible. Know what your credit score is, know what's on your credit report. It's really important. Credit Karma is great. Credit Sesame, the one that you get from any of your credit cards, they are great indications of where your score is roughly going to be. It's not going to necessarily match a hard pull because there's so many different formulas out there when it comes to credit scores. But that's going to give you some great information to know that, hey, I've dipped in too much into my credit card. It's over 30%. Or, hey, I just had a collection account hit for some medical stuff. It's a great indication. Don't take it as the final word, but it's a great tool to make sure that you understand what's going on with your credit. And the other thing too is don't deposit large sums of cash. Another kind of hard thing, especially if you're a landlord and someone, they couldn't get their checkbook or something like that. That can create issues as well too, because we have to be able to source those funds, and that can be difficult when you're depositing large amounts of cash. So I always tell people just, hey, listen, if you get cash, go use that to go buy your groceries, put gas in your car, whatever it might be, and then let your pay stubs or your other tenants' rents stay in the account and keep it higher for you.
yeah, well, that's a good point, like you made. For me personally, I do have quite a few properties, and I have an individual credit card for each one, and then I have an individual checking account for each entity. So, because I have multiple entities, so it does make it a lot easier. And then, of course, we rotate, like if I buy another one, pay this one off and use the card on another property. But, and it takes time to get your limits up on your credit cards to use them for these kind of things. So it's something, not that we're enforcing using credit cards, but if you can stay on top of your numbers and use it as a business tool, it can be a great tool. I know for me personally, I couldn't do it without, I swear I have a whole deck of them. So
I definitely do right in this drawer.
it's so bad. My poor bookkeeper. But it just is nice because you can put this property and all the expenses, and it's easier to track. And then you know what your actual expenses are at the end of the year when you go to do your taxes, and we want to track all the expenses we can. On another note, are there any, you guys are a pretty large lender. Do you have any geographic restrictions? Like, do you only loan in Mass? We do New Hampshire? Not that I go to Rhode Island or anything, but.
So I do all 50 states. So I'm actually doing a DSCR loan in Ohio right now. I just did one in Florida. I'm doing a couple. I've done a couple in Mass out on Cape Cod. I did a bank statement loan out there. So I've done a lot of these loans all over the country. The one thing I will say is some of the investors that we have aren't in every country. Massachusetts is one of the toughest places to get the banking commissioner to allow investors to do some of the stuff out there, especially for primary residences. The regulations in Mass are a little bit challenging, but I'll have investors that say, hey, listen, we can't lend and do like a bank statement loan on a primary residence. But I could do bank statement loans on investment properties and things like that. So there are some limitations when it comes to what investors might be able to go, but we have options for all these in all 50 states.
That's awesome. So we talked about non-income verification, or basically statement loans.
Yeah.
We talked about DSCR, which, say that again, was direct. What did that stand?
They are called debt service coverage
Yes,
ratio loans.
thank you, sorry. And we also talked about hard money lenders. Are there any other types of loans that an investor could consider as an option?
There can be. It gets challenging because there's a lot of like startup, almost like GoFundMe's now that people can try to go get people pool money. They can ask, hey, listen, like we're open to investors. We're looking for, let's say, $100,000 to do whatever it might be. They might ask for 10 investors at $10,000 each and things like that. It's all about being creative. You could also, let's say you find a property and the it's owned outright or something like that, you might be able to convince the property seller to do what's called seller financing as well too. I've seen that more as more of a talking point lately. I will say this, I haven't seen it be very productive in our market right now. I haven't seen a lot of sellers that are willing to do it unless you start kind of getting up into the plus 10, maybe 15, 20 unit complexes.
Hmm. Well, that's awesome. I really appreciate your time. I mean, I think this was so informative. I really appreciate you coming out, Mike. And I look forward to working with you in the future. Thank you for taking the time. And if anyone has any questions or would like to meet Mike in person, want to share your information, Mike, with your contact?
Yeah. So my email is mikev@getevolved.com. Or you can always call or text 978-501-5442. Happy to answer any questions or anything like that, because I know a lot of these could be specific scenarios kind of thing, and you might not want to jump in on a webinar to ask about it. But feel free to reach out to me. I'm happy to go over it and see if things make sense for you.
Oh, thank you very much, Mike. And if for any of your real estate needs, give us a call at the Real Estate Exchange, 978-582-4339. Have a wonderful day. Thank you, Mike. Have a
Thanks,
nice
Joanne.
week.
Have a good one.
You too. Bye-bye.
Bye.